welcome back. So in this session, we are going to discuss about introduction to option trading. And this is one of the interesting topic. I trust we all are going to enjoy it. So let's begin. So friends, it's all about me. Just to summarize, a passionate stock market guy, love to work with derivatives data, regular guest on all the business channel including CNBC TV18, CNBC Awaaz, Zee Business, ET Now, regular writers for Economic Times, Business Standard, Financial Chronicle, Financial Express, and also giving my inputs to Money Control, ET Online, having more than 25,000 Google link YouTube videos. So it's all about my passion keeps on coming, and the goal in the life is the next day should be the better than the previous day. So on this note, let's start with the basics of options trading. And you need to understand, if your basic concept is clear, the advanced level will be more easier. So foundation should be so strong that a multi-story building can be put on that. So guys, in this session, we'll talk about options. We'll deep dive into the same. So let's first talk about the options trading. So options is a derivatives product. Friends, you must be knowing we discuss about the equity market. Before that, there is IPO process, then listing happens, the trading happens. And in equity segment, we have the cash market and the derivatives market. Derivatives market is all about the leverage product, where just by paying a small amount, you can take the comparatively higher exposure. In derivatives segment, we have futures and options. So in this session, we are going to talk about options trading. So guys, if you look at the options, that means a contract which gives the right but not the obligation to buy in case of call option or sell in case of put options. What kind of right or to buy or sell? That is on specified underlying assets at a specified price, that is called the strike price, on a specified future that is called the expiry date. So just to summarize in the practical terminology, option is a contract in terms of call option which gives buyer the right to buy the underlying of the particular expiry, while for the put buyers, he gets the right to sell the underlying on that particular expiry for that particular strikes. I'll just give an example. Let's say the Nifty future is trading near to 11,900. I'm buying 11,900 strike call at 100 rupees. So by just paying this 100 rupees, I'm getting the right for the positive momentum if market moves above 11,900. But in the reality, my break-even will be 11,900 plus 100 rupees. That is my premium for the buying of this call options. And if market moves higher than that, say in that particular expiry contract in which I have taken the options, I'll be profitable. But if market goes down and if I have bought the call, my profit is limited to the premium, whatever be the market scenario on the downside. Similarly, on the put side, let's say the Nifty is trading at 11,900. I'm buying 11,900 put at 100 rupees. If market goes down below 11,900 and settles on the expiry, I'm in profit. But if it moves up, my maximum risk is limited to the premium of the put of 11,900 strike, which I paid. So this is very interesting topic, and guys, you must be knowing that 90% trading activities is happening into the option segment, and that is mainly in the index option segment. So option is very interesting topic to understand and learn, and also to make money. And the beauty of option is you can apply it for any kind of market scenario, whether the bullish, bearish, range bound and the volatile, but you should be knowing how to execute and how to implement the same. Friends, from last couple of years, Indian markets in the equity derivative segment started to see the weekly expiry, and after that, the people enjoying more like the T20 matches of the options. So a better learning in such kind of market can reward you with your handsome return on investment scenario. So we'll understand why options, what is the difference between the future two options, when to trade buy call options, buy put options, benefit or difference between buying options and selling options. Then we will discuss the bit common sense about the option Greeks, all the way from delta gamma theta vega rho to the binomial and the black and short. But we'll try to make it more practical so that you can learn and utilize into the live market. So friends, when we are paying the premium for any kind of options, for the particular strike price, for particular maturity, the price is called the premium. Now let's say the 11,900 call is trading at 100 rupees. That 100 rupees is the premium. And by paying this premium, the option buyer gets the right? And by receiving this premium, option seller gets the obligation and transfer the right to the options buyer. So premium is very important aspect in the option segment. So we need to understand that how option premium keeps on moving up and down, and how we can get the trading of the options premium for sale. So in the option segment, the price is called the premium and is paid by the buyer to the seller. And usually in the option terminology, the option seller is also known as the option writers. So in the PPT, many times we call them option writers, or many times we say like option seller. Both are same. So now talking about the options trading in the basic side.
Register for our free webinar. Download our app today. Link in description.